Hello everyone and welcome back to Financial Trading Basics. I believe this is part 4. And this one is titled Day Trading the Small, Medium, and Large Cap Stocks. If you talk to any day trader, this is typically what they're trading. Stocks priced between, I don't know, $1 and $1,500. It's been a little bit since I've made a finance video, so I'll probably review some things I've already said. But I'm going to talk about how I personally approach the market, what I think is overwhelmingly evident about how the market actually changes, and how I try to make money doing so. So, trying to pick up where we left off, I have written the same patterns emerge because of human emotions. Every stock trader looks at charts, say every, but most, if not everyone today. And they all use patterns. You'll hear golden cross, the death cross, ascending and descending triangles, head and shoulder patterns. And I'm working on rigorously proving that in my mathematical research, but I am absolutely confident these are all trailing indicators that are present and emergent because of human emotion. Emotion affects your decision-making skills. It certainly affects your financial decision-making skills. And once you look at a stock trade or a price action of a stock over a week or a month or 2 years or whatever, you will see patterns, but they only indicate things about the past. And we want to say, how do we make money today or tomorrow? So all of the indicators are lagging indicators. So what does matter to make money? Well, managing a position is substantially more important than a specific stock pick or stock direction. You think Apple is going to go really high, you buy calls or you go long on the stock. Regardless of that decision right there, the way to really build long-term portfolio value is managing your emotions and managing that position. Take any stock trade you accept, you will be able to look at it in hindsight, and if you went long, if you could have been profitable or taken a loss on that long position, while simultaneously in that same time frame, you could have gone short on that stock and either made money or lose money. Remember, the only thing you are trying to do in the stock market is get into a position that goes in your favor, and then you take your stop loss and you put it exactly on whatever your risk tolerance is, or simply your entry price, or your profit, the minimum profit you would like to take. But the thing that really matters is once you take, the way I do it is I never add to a losing position, and I always add to a winning position. So I take, I have my $100 a week, $200 a week, whatever. That is what I'm willing to lose on a given trade. And now I'm going to try to find trends that are extremely, extremely extended. There's tons and tons of variables that affect the stock market's price. I'm going to look for stocks that have the most variables extended one way or the other, and then take the opposite position. Simple as that. But really, you can read popular books, you can watch podcasts, you can do this. 99% of traders want to tell you when and where to pick a stock. You can't do that. 0% of profitable traders do that. They manage their portfolios very well. Okay, so that's how can we build long-term portfolio value? Well, a lot of people will tell you conventional wisdom says that you shouldn't try to time the market. Wrong. You absolutely should try. You should just manage your losses. But the reason being is because you can have a single trade or 5 trades that if you manage it properly, that will literally make your year or your decade. And conversely, if let's say you appreciate $1 million. Well, I want to talk about confirmation bias as well. The timing of the market is really the thing that everyone tries to figure out. Because let's say you appreciate $1 million on your account over a year and a half using a given chart pattern that you think is really good. Well, a year on a stock market or on a financial market is rounding up, that is 0 time at all. So timing the market and managing your risk, and when you understand that is the game that you are playing, if you make a lot of money, you're never going to think you're really, really smart in beating the market. Or if you lose small amounts of money over a long period of time, it's not necessarily that you're doing something wrong. This is just the dynamics of how the market works because there are so many independent players. So now what we're going to do is we're going to talk about how I try to time the market and these patterns that I see as emergent simply from observing the market over a long period of time. So what patterns emerge in the market and at what time do they emerge? Well, your stock market opens at 9:30 Eastern Standard Time and it closes at 1600 Eastern Standard Time, 4 p.m. And during those times, there are just, because of the opening and closing of the market, there's certain times when there's a lot of volume and times when there's not a lot of volume. Obviously, the pre-market and the post-market, the biggest differentiation about those times is your spreads are a lot bigger and there's way, way less volume. So now I want you to think, like I just said on the last one, we're going to look for as many extended variables as possible and take the opposite direction. So if you have a company that comes out, and I'll use a specific example here, Roku. I've traded them. I'm probably year to date. I'm probably down $1,000 or $1,100 over, I don't know, 15 trades on Roku. But it's been a very hot stock this year, just very popular. But I don't know. Today is the 19th, November 19th. It is 2:15 p.m. Roku was at, like, I don't know, 3 weeks ago, just Google the charts. But like 3 weeks ago, Roku was at 145, maybe 2 weeks ago. It was at like 145. They missed earnings or had a conference call, and then the next day they opened up pre-market. They came down and hit, I think it was like $118, and and then they opened up, I think, 120. Typically, when you have something, so from 9:30 to 10:15 Eastern Standard Time, the two types of positions that I enter are shorting failed breakouts, and I'll give another example there, and then buying the oversold dumps. And getting back to the Roku example, the stock has been, I think it's up over like 18 months. I mean, we're up from like $30 to at a peak of $170. But we have a stock that is very bullish, or has been very appreciative over the past 18 months. It missed a call, or missed a conference call or earnings call, and the stock comes out and it opens up, 40% lower. But remember, that change happened pre and post market. Most conference calls are made after the bell. So you have a lot less volume. Typically, when you have an oversold dump, you flush out for the first, honestly, for an oversold dump, you might flush out for the first 5 minutes of the market open, maybe not even the first 30 minutes, but then they recover substantially. So if you have a company that comes out, pre-market, they're down very hard, I'm typically looking to take a long position after the initial flush out once the market opens. Conversely, if you have a stock, and this is the one I traded today, the 19th, and I lost $100 on this one. But conversely, you'll have a stock come out, MYOV, they had, it was some result for prostate cancer. But they were up, I think the stock was at $6 yesterday, and it opened, I don't know, 14, 15 bucks, hit $17. I was in there short at $14.78, and my stop was at $2 above, so it was at $16.78, and the stock literally hit $17, craps me out $100, and then right now at $2.20, it's at like $12. But the point is, during the pre-market, there's very little volume. Between 9:30 and 10:15, there's the most volume. So this is the most volatile time of the market. This is where, in accordance, this is when you have the time to enter a position to make the most money on a given day. On a previous lecture, I talked about developing a prospectus. You want your prospectus to look at, again, if you're playing a 3-day move, you want to be looking at 18-month charts, year charts, 3-month charts, and then weekly charts. If you're trying to play a move over an hour, 18-month charts don't matter. So whatever time frame you expect to manage or have the trade, you want to look, you know, 10x, 15x, whatever, past that, or zoom out, or again. But if you're intraday trading something that's happened 18 months ago, probably isn't that all of that important. I will say, however, unless it's an IPO or a stock that's at an all-time high. If you're in uncharted territories, for a specific example, this MYOV, this stock has traded at like $27 in the past 18 months. So when it gaps up at from $6 to $17, it's certainly a noticeable appreciation, but you're not blowing out every expectation that the company's ever had. And getting back to what I was saying about the volume, this is when you have the most volume. This is when you have your flush outs, and this is when you have your failed breakouts. MYOV was a great example. I lost $100 on it, but it hits the $17, and then it flushes out for the rest of the day. And these, I would say, these are even more so than buying the oversold dumps. I would say these are 70% of the trades I take. Now, from 10:15 to 1 o'clock, that's typical. I don't really take many positions there. If I do, it's buying all day runners. And this is one of the cooler stocks I've seen, KRTX. This is gapped up from, it was like $30. I think it gapped up to $30. But it opened yesterday right around 30, 40 bucks. Intraday yesterday hit $90. Today intraday hit 150 bucks a share. So you're talking appreciation of over $100 a share in 2 trading sessions. And when those happens, the KRTX, unless I'm missing a chart or they renamed themselves, this one gapped up yesterday above its all-time high. And so I don't play these all of the time. If I do, I always play them long, because you don't want to be short on a stock that starts appreciating $10 a minute, and then you get halted. That is what risk tolerance, shorting very, very aggressive long positions, that is the opposite of risk tolerance. But I really don't take many positions during this time of the day. And then because you need, again, once we get into more developed strategies, we'll talk about holding positions open overnight and hedging them with options. But getting into stock trading, you really shouldn't, on a day trade, you really shouldn't expect to hold anything overnight. And then from 1 o'clock in the afternoon to the close, I'll be looking to short stocks that have had moderate appreciation. They're just trending throughout the day, like a Kroger or a Caterpillar or something. There's no news going on, but it's a $130 stock that's moved $10, and I'll just take whatever the opposite position is. But I'm really opening most of my daily positions. I personally look for really, really, like I said, exaggerated trends on the intraday in 3 to 5 days of price action. But yeah, these are the patterns that I play, with the added fact that, again, if I lose my risk tolerance, I am done for the day. If I make money, I take half of my profit and I put it into my portfolio to be used for future trades, and then I might take 10 to 20% of that other profit and go take a more risky trade or just risk more on a different trade. But really, to avoid over trading, there's going to be 1, 2, 3 stocks on a given day that are really, really moving. And again, you don't need, if you want to make a $10 million portfolio from $10,000, you can do it with a couple trades. I mean, you do not need a lot of stocks to trade. You just need to manage your money. But these are, and they said this is evident. If you go talk to any traders, 3-day flush outs are very, very common, and those are the best times to take your positions. And I would like to conclude this episode with the fun part of trading. How do you manage a winning trade? Well, I have written up here, managing profits and losses. The risk tolerance is pretty easy. So that's your initial risk, and that's how you manage a loss. You're willing to lose that money. Typically, I would say 80% of the time on my initial entries, I always let my losses hit the stop losses, because that's really how I avoid overtrading personally, is if I'm wrong on a move on a day. And remember, those things I just showed you, those are all super guidelines. Those are not, you do that every time you're going to make money. Absolutely not. Those are just the most likely scenarios to make you money. and the time to do so. But you can be wrong. You can, between that there's a lot of time between 9:30 and 10:15. But most of the time it's around 10:15 is when they crash out. But you can just simply be wrong on the move. You could have what you think to be a failed breakout is just an all-day runner, and then you're just kind of out. But setting a risk tolerance and actually letting it hit the stop loss, that is how I personally don't overtrade. And now the fun part. You get into a stock position and it starts going very in your favor. What do? Well, all right, if you enter a position, if you enter a long position at $1 and the stock is, and you have 1,000 shares, the stock is now $3. You've just made $2,000. And maybe you're excited about that profit. Maybe that is a lot of money. You're like, yeah, this is sweet. I can go on vacation, whatever. Well, maybe you just take your profit then. But what we're trying to do is make the most amount of money. And once you're in a stock, if your price average is $1 and it's at $3, truly, why not throw your entire account if you think the trend's going to continue? I personally put my entire accounts on winning trades, as long as I can manage that risk. If I know, and this is that. Sometimes they're intraday, sometimes they're over a course of days. I would say for a beginner, unless you really know what you're doing, do not risk overnight trades at all. But the reason you don't overtrade, and then the reason that you should add extremely heavy to winning trades, is you've back-weighted your price average. And you might say, okay, let's say you go up $2,000 on a trade, you dump your whole account on the thing, and then you put your stop loss at a decent profit still above your entry, and you get crapped out and you make $800. Still good money. I mean, to make $60,000 a year, I think you need to average $250 a day. So you should probably have a realistic goal target that you want for your profit, and any time that it hits that, you should probably not take the profit, but put your stop loss there. If the trend continues in your favor, fantastic. You might make $20,000 or $200,000. But you know you're still going to make money. And guess what? You're going to wake up tomorrow, you're going to have $800 in your account, $2,000 in your account, $20,000 in your account, and you can take more trades. And the trades are going to be there. Like I said, there are very aggressive runners and dumps. I would say not every day, but I would say there's 1 to 3 very good trades a day, and for sure 3 to 4 very good trades a week. So the opportunity far out extends the actual trades you'll either take or you should take. I mean, even if you have $1 million account or $1 billion account, it doesn't necessarily make all that much sense to take a bunch of different trades. Again, well, if you define your risk tolerance to accommodate for 4 or 5 positions, it's the same approach. But always add. My advice is to always add, and to add very aggressively to winning trades. In that event, you hit that KRTX, that right. You enter a stock at $30, it goes up to $40 a share. You dump your whole account on the thing. 2 hours later, you're at $90 a share. The next day, you're at $150. And again, if you took your profits yesterday at $80, $70, whatever, and you made, I mean, truthfully, my position sizes are typically, after I've added, is about 1,000 to 5,000 shares. And I typically go for $1 to $5 a share profit target on a given trade. If you're hitting $10, $20, $30 a share on a trade, then those are the big ones. Like I said, those can make your life, man. Those can really, really change your entire portfolio. One trade, 24 hours, baby. Let's get it. But I never add to a losing trade. If I have lost, if I'm wrong on the move, or I'm just have a shitty entry, well, I go down with my ship and I let it hit the stop loss. I guess I want to talk about one other thing. Do I ever personally not let it hit the stop loss? Do I ever change my opinion mid-trade? And the answer is yes, but frankly that is because I've literally been, over the past 4 or 5 years, I've spent more time watching stock tickers jiggle up and down than anything else. Well, maybe not math, but it's just, once you've traded for a while and you have some profitability and you are confident, I would say you might not let it hit the stop loss. But again, if you start micromanaging your trades, you'll probably overtrade. And that's the conclusion of this lecture.